Probably no surprise, the Fed did not increase rates or change rates. But what was most important is what was in between the lines in terms of the press conference to follow. Okay, inflation is high again, teeing up a all-important Fed meeting here this week. My name is Brandon Steele, financial advisor with Mainsail Financial Group, and our goal every Thursday is to bring to you the market news, the data, the trends we're watching, hopefully weed out a bit of the noise along the way. And this week is yet again focused around the Fed and interest rates and kind of what we see ahead here. But most importantly, breaking down some of the Fed commentary, because it's probably no surprise the Fed did not increase rates or change rates. But what was most important is what was in between the lines in terms of the press conference to follow. So before we get into the core of that, I do want to touch on some data on Friday before inflation, which was personal income and spending. So personal income was up 0.5%. That will tie in soon here when I talk a little bit about some of the Fed press conference, because they are very closely watching wage inflation as well now, and certainly became more of a forefront topic than it had been. And then personal spending was also up 0.8%, significantly up, I should say, and well above expectations. Yet again, which seems to be the theme every month that we get this spending data. People just keep on spending, and so I think we've certainly seen the consumer. It's strong. Will that show itself with some cracks in the future? We'll find out. But nonetheless, consumer, you and I, we are spending, and so certainly seeing that in the spending numbers in general. Also on Friday, we had PCE inflation data come out. So both the headline and the core inflation data was up 0.3% for the month. So again, headline is basically the basket of goods and services. And then core PCE takes out food and energy. So those are meant to be the more volatile categories. You strip those out and we get core PCE. But either way, they were both up 0.3%, mostly in line with expectations. I believe the headline number was expected to be about 0.4%. But the most important thing is, regardless of expectations, again, another higher inflation data point to feed into what we talk about here in a little bit with the Fed. And lastly, this actually, I wasn't even going to cover this, except that it will tie in very well to some of our Fed talk. On Wednesday, we also had job openings. So this week, we have inflation, jobs, and the Fed, which is like the trifecta. And basically, job openings on Wednesday showed a recent low. And again, normally this is the ADP employment report. This is usually after the Fed. We don't cover it all that much. But this all ties into the Fed conversation. So keep these data points in mind. Higher inflation, lower job openings, all right? Okay, so with all that, Fed press conference was just yesterday on Wednesday. The decision, again, probably no surprise for most, but they are keeping rates unchanged. So as a result of that, we saw basically yields, bond yields go down, and we saw stocks up after the statement and prior to questions, and we kind of saw that continue through the press conference as well, especially in the early stages. However, one of the things that they are doing is they're going to start slowing, the runoff of the balance sheet starting in June, which is basically when the next meeting is as well. But some of the things I wanted to highlight is more so around the changes in the Fed rhetoric and tone. So last meeting, there's a lot of similarities here, so bear with me a little bit. But last meeting, they talked about inflation has eased over the past year, but remains elevated. Now, the big addition is that inflation has eased over the past year, but remains elevated. And then they added, in recent months, there's been a lack of further progress towards the 2% inflation target, basically. And so I think the reason that that's important is because it is showing that, as we've talked about time and time again, inflation is stickier than expected, and the Fed is certainly acknowledging that here now. One of the things that I think was also a big takeaway, although this probably isn't much of a surprise, but they said there's unlikely a hike in the cards basically at all. So they all but took a hike out of the equation. But the other thing that was the biggest takeaway for me was that they had basically suggested that now that inflation, as inflation comes down, I should say, they're now focusing on their other goal, which is the employment goal. And basically he shared that now comes into the focus. And so the reason I wanted to share this is because up until this point, the Fed has not talked about jobs really at all. They haven't talked about employment hardly at all. It's been something they've highlighted as a shining, star, so to speak, in the economy. but they've never talked about it in terms of how less jobs would relate to a lower interest rate. And this is the first time that's really been the case. So the reason I think this is important is because we've been so focused on inflation up until this point and how that might relate to interest rate cuts. It is very clear that the Fed is now trying to find maybe another angle to find ways to cut, and really pointing towards the jobs numbers as possibly that reason. So coming back to the data point recently, right? Inflation staying higher, job openings decreasing. So the reason I wanted to highlight that is, again, because with what he is sharing here, apparently that's much more of a weighing factor than he has shared in the past, and certainly something to keep an eye out for moving forward. I think in overall, the message was very dovish, meaning that it was very loose policy, basically. In other words, meaning that the markets liked it. Let's put it that way. I will say, though, that I think it was a quick reaction from the markets, because I don't think the Fed said anything about cutting rates anytime sooner. It just took rate raises off of the table. And so, to see the market react the way that it did, I think shows how much optimism is out there, basically. But the added labor market data into the conversation, I think, does make some big changes in terms of what we need to watch, because now it's not just about inflation, but also even more heavily around the job side of it as well. Okay, so that's a lot. And again, it's a lot of the between the lines, reading here, so to speak. But it is important because I think we all knew the Fed wasn't going to make changes this meeting. It was more about what they shared moving forward. And it would seem that they're looking for a reason to cut. And they may not do it just because, but adding the labor market into the mix looks like they're looking for a reason. Coming up next week, we have non-farm payrolls tomorrow. So jobs data, which apparently, again, is just as important as inflation now in the Fed conversation. And then next week is a little bit lighter on data, but of course, a lot of earnings still to come as well. Before we break for the week, I want to cover a great question of the week, which is certainly a hot topic right now, and it's about the Fed's impact to CD rates. So we haven't covered this for a long time because rates have been up for so long. But I thought it was very timely, given what we're dealing with in terms of whether the Fed cuts, or what how long we stay higher for longer, so to speak. And so what I wanted to share to maybe start is that the important thing to keep in mind is what the Fed actually dictates, which is what's called the federal funds rate. And basically, the federal funds rate is the rate that commercial banks either borrow or lend money for their excess reserves overnight. All right. So it doesn't sound like that would have much of an impact on us as consumers, or people who are maybe looking for CDs or money markets or whatever it might be. But the reason that's important is because, in general, CDs are not exactly tied to that rate, but tend to move in the same trend as that rate, because obviously that ties to how the bank deals with their money as well, and therefore can dictate how much they can provide on the back end. So anyways, long story short, what I'll share is that the most recent Fed decision, I don't think really makes much of an impact to CD rates. In general, there might be some shorter term volatility around that as banks try and figure out what the Fed does next. The other thing to highlight is that right now with CD rates, similar to bonds, we're in a weird situation where shorter CDs are actually paying a higher interest than longer term CDs. And that's not normal. And the reason for that is because you're giving the bank your money for longer. And in general, you would expect more in return for that. But the reason that's the case is because banks are expecting that rates will come down in the future. And so they are not willing to offer as much, knowing that it's very likely rates come down the road. And if they were to offer, for instance, a 5.5% rate for 5 years, they could get kind of upside down pretty quickly on that. So that is an important factor to watch. And I think what we'll maybe see from some of the results of the conversation today is probably not a lot of impact to CD rates, but as we get closer to the next meeting, or the Fed actually shares that they're going to cut rates, it very likely will have an impact on CD rates. And especially as you look, let's say, to the mid or longer term maturities, where the bank is really hedging against future rate cuts as well. So I thought that was really an important question to cover here today. And rather than focusing entirely just on the Fed, talk about how that relates to interest rates and what you might expect out there in terms of CDs and money markets. Thanks for joining us here this week. I hope this was helpful. Definitely let me know if you have any questions and we'll try and cover them next week. Otherwise, have a great upcoming weekend and we'll see you next Thursday at 3.